75% of investors who own Dividend Aristocrats never sell them. And that's exactly how you turn a great dividend stock into a decade-long money trap. Hey, welcome back to Wealth Blueprint. I'm going to show you something most dividend investors refuse to see. The moment when your safest, most reliable dividend stocks quietly stop making you money. Let's be honest, Dividend Aristocrats feel safe. They've raised their dividends for 25, 30, even 40 plus years. The marketing is beautiful, but safety and returns are not the same thing. And that's where most people get stuck. Here's the problem. Having a rising dividend doesn't mean you're getting wealthy. It just means the company sent you more money than last year. Your total return, dividend plus stock price appreciation, is what actually builds wealth. And plenty of aristocrats have stopped delivering on that second part entirely. I've watched investors hold stocks like Realty Income, Altria, and others for years, celebrating the dividend raise while their total return sits flat. Meanwhile, they could have deployed that capital into a company with actual growth momentum. That's opportunity cost, and it's brutal over decades. So let's walk through the 3 red flags that tell you a dividend aristocrat is becoming a value trap. Red flag number 1, payout ratio creep. When a company first becomes an aristocrat, the payout ratio, what percentage of earnings goes to dividends, is usually 40–50%. That leaves room for investment in the business, acquisitions, and safety margins. But watch what happens as the business matures. The payout ratio starts climbing, 55%, 60–70%. Some hit 80 or 90%. Why? Because the company's core business stops growing. So instead of investing profits back into innovation or market share, they hand it all to shareholders. It looks generous. It's actually a warning sign that management has run out of ideas. Here's what kills me. Investors see a higher payout ratio and think more dividend for me. But you're actually seeing the company cannibalize itself. When earnings get hit, and they always do eventually, where does the dividend get cut? That's your answer. Check the 5-year trend. If the payout ratio has climbed more than 10 percentage points, you need to ask why. Is earnings growing, or is the dividend growing faster than earnings? That's unsustainable, and the market will eventually reprice it. Red flag number 2, slowing business growth. This one is critical, and most people miss it entirely. A dividend aristocrat's stock price can be flat, but the dividend keeps rising. So you feel like you're winning, your yield on cost goes up every year. But here's the reality. If the underlying business isn't growing, you're extracting cash that should be reinvested. Look at revenue growth. Look at earnings growth, not the dividend, the actual business. If revenue is stalling, if margins are contracting, if the company is losing market share, the dividend raise is a distraction. It's the CEO telling shareholders, the business is boring, but at least we'll pay you. That's fine for year 1. For year 5, you should be looking elsewhere. A classic example, utility stocks. Many are aristocrats, but their businesses grow maybe 1–2% a year because they're regulated. The dividend is safe, but your total return caps out. If you need real wealth building, not just cash flow, utilities might not be your answer. Pull the 5–10-year revenue and earnings growth rates. If they're below GDP growth, you need to ask, am I getting paid enough in dividend to justify sitting in a stagnant business? Usually the answer is no. Red flag number 3, shareholder dilution. Here's a sneaky one that almost nobody talks about. A company can raise dividends while simultaneously diluting shareholders through stock buybacks, done wrong, executive stock compensation, or conversions. Your dividend per share goes up 3%, but the total share count goes up 2%. Guess what? The company's earnings per share growth is slower than it looks. Worse, if they're buying back stock at inflated prices while growth stalls, they're destroying shareholder value in real time. They're just hiding it with the dividend raise. Check the diluted share count over time. If it's consistently rising while earnings are flat, you're watching value destruction dressed up as a dividend increase. Now here's your decision framework, the one that actually works. Every quarter, ask yourself 3 questions. 1. If this stock had 0 dividend, would I buy it today at this price? If the answer is no, you should probably sell it. The dividend is just candy covering up the fact that the underlying business is uninspiring. 2. What's my total return been over the last 3 to 5 years? Include the dividend. Compare it to the S&P 500 or a diversified ETF. If you're underperforming, even by a little, you're getting paid for boredom. That's not wealth building, that's settling. 3. Is the dividend growing faster than earnings? If yes, you have maybe 2 to 3 years before reality hits. Then it's time to exit. When should you actually sell? Sell when payout ratio exceeds 75% and revenue growth is below 3%. Sell when the stock has underperformed the market for 3+ years. Sell when you realize you're holding it for income, not growth, but you don't actually need that specific income stream.